Hi, folks. Welcome. It's great to be with everyone. I'm David Russell, VP of Market Intelligence here at TradeStation, and today we're going to be looking at ways to find opportunities in the new year and find leadership in the market using some of the great tools we have on the TradeStation platform. Here, just look at these disclosures about TradeStation security and different companies that are involved with TradeStation. And I would also just very quickly now I want to point your attention to the zip file that we shared. So there's a zip file. That zip file contains our workspace that we're going to be working with. So this is what it looks like if you open up that zip file. You're going to see three things. This is the actual slides I'm presenting, so you don't have to take notes. The PDF of the slides are provided. Next, you have this file, the Opportunities in Any Market Easy Language document. It's the one with a little like green thing on it. You want to double click on that first, and it's going to bring up with TradeStation open. It's going to bring up this wizard, and that wizard will now import a series of studies that we're going to be needing for the workspace. Now, I already have them on my computer, so I'm not going to import them, but you would hit finish and it would import them in. Some of these are ones that we've shared with people before, and there are some new ones as well. So you want to import those studies, and when that is done, then you can actually open up the workspace. Okay, so we're going to basically, that was me showing you how to open up the indicators and tools. And we're going to take a look at some of the trends that seem to be emerging for next year. And we're going to show ways, essentially three different sort of ways to use the platform. One of them is finding leadership with ETFs. Another is finding leadership with stocks. And another one is using Scanner to find leadership with stocks. We're mostly going to be using Radar Screen and Scanner, the tools in the TradeStation desktop. All right, now before we get started, I want to very quickly just review where we actually stand in the market right now, because it's an interesting sort of situation we're in. This is the S&P 500. I want to just very quickly just show you this chart. I added to this chart the 100-day moving average because I wanted to quickly review this just based on what's happened in the last few days. So let's just take a quick look at just consider some of the things that have been happening recently. When you look in the last 3 to 4 weeks, we have seen multiple, I want to talk about the macro situation very quickly. We have multiple sources of information showing a decline of rents and housing costs. That comes from companies like RealPage, Apartment List, and Redfin. If you Google all of those, you can see that we've seen a drop in renting costs. We've seen used car prices fall. There was a recent article from Manheim. Goldman Sachs predicts inflation is going to be under 3% next year. Now, if you look at the Institute for Supply Management, they came out with their last services index, and they said this, quote, increased capacity and shorter lead times have resulted in continued improvement in supply chain and logistics performance. That suggests that inflationary pressures are easing. We had the consumer price index was below estimates, and the service cost actually fell. We had the PCE, which comes out later in the month, that was also below estimates, both the top and the core. Gas Buddy, which runs an app that finds gas prices around the country, predicted gasoline is going under $3 by the end of this year. Jerome Powell said on November 30th, if current trends continue, goods prices should begin to exert downward pressure in overall inflation in coming months. So it's just interesting when you take a look back, and we wrote about this back in 2020, used car prices, the ISM price indexes, and lumber were all leading indicators of inflation. And now all of those have been falling. So now the lagging, slower moving things like rental prices, those are starting to fall as well now. Another thing is that there are the futures prices that predict interest rate changes based on what the Fed is doing, the CME FedWatch tool. That has really shown no substantive change. We had that strong payroll numbers last week. That doesn't show any increased expectation of Fed hikes next year. And then when you look at other indicators, like, for example, junk bond spreads are not showing any kind of deterioration. So those things actually suggest, despite what a lot of people might be saying, that a soft landing scenario might actually be taking shape before our eyes. Inflation coming down on multiple fronts, including a real sell-off in energy prices recently. And then we also see the economy weakening, but no, there's no real sign of an economic, collapse or hard landing. So it's the pieces are coming together where it's not that unreasonable to start to think that maybe a soft landing is possible. So I want to just mention that because if you look at the index here right now, all right, now let's look at this. This is the S&P 500. There's been a level that has basically ever since the half began back in July. This was a high and it was a low. It was a low and we broke under it. We held here and then we're holding it again. And the cash index is 3910. This is SPY. The other thing is, yes, the 200-day moving average is coming down, but the 100-day moving average seems to be providing support from below. So the key point is we're going into next week with two major events, CPI on Tuesday, the Fed on Wednesday, and we're squeezing into a very tight range before those events. So I just think it's kind of interesting to bear that in mind. I would emphasize that also, this doesn't necessarily mean the market is going to go higher into year end. There's a lot of negative sentiment, the potential for tax loss selling. And the other thing is that you still have this problem of some of the large technology stocks that are not in favor right now, and they have such a heavy weighting on the indexes that can also be a wet blanket into year end. But I want to just lay out some of these things ahead of us because in many ways they are important for some of the things we're going to be talking about in today's webinar. So I wanted to just show that some of the things popping up. Now I just removed 100-day because it's not on your workspace. And this is the workspace you guys will now see. So we're going to go over some of the things on this workspace. All right, now going on to slide 7. So what's in store for 2023? So my approach for this is to basically notice that the market passes through multi-year periods, like phases or epochs, when certain sectors and industries tend to lead or tend to lag. What we want to do here is we want to identify those trends with the leadership, and then we want to find ways to position accordingly. That is the goal of what we're looking to do. So I call these things market phases. And what they are is they are times when certain areas do better than others. The last 5 to 6 years have been dominated by large cap tech. Most people know that. And there's ways you can actually see it based on real hard numbers, real quantitative measures, and that's what we want to actually do. So the main thing that we can see is that relative strength, which compares a sector to the S&P 500, is the simplest way to spot leadership or a phase in the market. That's first thing, relative strength. Now, the second thing is that most of these phases are kind of, regimes, they make sense in some kind of big picture way. So, for example, the last 5 to 6 years of big tech, it was the period of cloud computing growth. It was also a period of low interest rates, and it was a period of low inflation and not a lot of, strong economic growth, the way that we saw coming out of COVID. So the thing is that made sense. So now when we look forward, we also want to find something that can make sense from a fundamental perspective. Very often, you often find that the areas that do well coming out of a crisis are actually the areas that had been lagged or were totally neglected or forgotten. If you look at technology, it did very poorly between 2000 and 2009. And then coming out of the financial crisis, technology led. So it's interesting just to kind of see that some of the areas that might do well in 2023 could totally be areas that are not on anyone's radar because they've been forgotten for years. So what's also interesting is very often the strength will emerge during the actual bear market or the correction. So what are we in right now? We're in a bear market or a correction. So now is the time that we want to be looking for these potential new leaders. All right, we're going to slide 9. So these are other phases. Now I created another little workspace just really quickly to kind of show this. I want to just show you this on this chart. So for example, an earlier phase, if you look on slide 9, was housing in the early 2000s. Now, this is a monthly chart, and this is using relative strength. And this is similar to what you have on your chart. I just wanted to quickly show this. This is the $HGX, which is the Philadelphia Housing Sector Index. What's very interesting is, look during 2003 and 2004, this was long before the housing bubble broke. You could see that this shows the performance of the HGX against the SPY. These are monthly candles, and it basically has the trailing 6-month performance. So what you can see here is that you can see this relative strength of housing that was obvious very early in the cycle. Another example is if we look at something like commodities. If we look at something like energy. Why? I think we can start with XME. Let me see if I can get this to work. No, let's start with, when you look at energy, you can also see energy was bad for a long time. And then in this period of time, long before oil went over $100, you can see this relative outperformance of energy. And then if you look at another thing coming out of 2012, after Obamacare passed, you see this period of outperformance in healthcare, XLV. So this was also another sort of regime. What's interesting is each of these began during a period of a correction or a bear market. And then if you look at technology, XLK, you also had that period of weakness in 2016 during Brexit, before Trump got elected. In here, when basically the market went sideways for about 18 months, during that time, you could start to see the relative strength in technology. And then you could see that it was breaking out toward the end of that period. And then that outperformance continued. So right now, it could be time to be looking for similar sort of patterns. All right, so what's in store for 2023? These are things that I see that are starting to emerge on slide 10, okay? First of all, the potential for the end of Fed rate hikes. And when you think about that, there's going to be some different implications for that. One of them would be the potential for the housing sector to recover. There is still structural demand for houses. And, at this point in time, the mortgage rates, as they start to ease, there's a good chance that there's going to be pent up demand, that they don't have to go back to where they were. There are people who want to come back in and be buying homes. And with an easing of interest rates, that's going to be one of the first places where people look. Another thing is, in many ways, the financials. When you look at some of the big banks, the yield curve right now is totally unfavorable for the banks. As the Fed stops, what you could start to see is, as a sense of economic growth recovers and a fear of recession eases, what will happen is the longer term rates will actually kind of inch higher. The yield curve simply returns more to normal. And that alone, when you look at where the banks are, that could be a trend that people look for. And we're going to show you some interesting things that are actually happening with the financials. Another thing that seems to be happening is there is this push toward green energy, solar energy. We've written about that different times on Market Insights and other areas, and the solar energy area seems to be outperforming. At this point, continued strength in the job market. That's something which argues in favor of a lot of cyclical, industrial, potentially consumer discretionary financial stocks, not the big cap sort of technology stocks as much anymore. And then just an ongoing normalization of supply chain, like the Institute for Supply Management said. Those are some of the main things that are popping up here I want to mention. The other thing that I didn't put on here was the potential for further weakening of the US dollar and a return to the global trade. Things like European stocks, potentially Asia, Latin America, all those have lagged for a long time. And this last sort of rally in the dollar, if that does fade and the Fed pauses, that might also draw people back to a lot of these global stocks. What's interesting is everything I'm saying, a lot of these things are not what has been the trend for the last 5 to 8 years. Global has been mostly weak for a lot of that time. So we could actually see, like I said, it goes through a period where the things that were weak can often, after a long period of resting, people can come back to them. Some of the other things we have seen, are just the relative outperformance of the Dow against the NASDAQ. Stocks like Boeing taking off again, Caterpillar, Merck, Amgen. Just today, we did an article on TradingView about the breakout in Amgen. These are members of the Dow Jones Industrial Average. Also, a lot of engineering stocks and industrial stocks have been doing well, which is kind of interesting. What I would just also point out to you, if we look over here, for example, there's stocks you haven't heard much about, like ADP, which is the employment, payrolls company. If we're going into a recession, this stock, it's strange to see it going to new 52-week highs and consolidating there. A stock like Cintas. Now, these are not stocks people trade a lot, but this company provides uniforms for employees. It's highly cyclical to the job market, and it is not showing these signs of strain. And these can be some of the areas. Some of those other companies, like, for example, FLR, these are engineering firms. They do all kinds of construction projects, and these stocks have been really breaking out. These are not consistent with a recession, these things I'm talking about. And these are some of the things we might see more of. It's also interesting to see, we continue to see property and casualty insurers, like companies like Travelers and Allstate and Progressive, do well. And one of the reasons is because they've all raised their premiums, and they all, in some ways, are benefiting from inflation. And then on the flip side, just a general sort of, difficulty in cloud computing, advertising, video games. All right, so we can find this counter leadership with ETFs. They track a wide variety of sectors and industries, and this makes them potentially useful analytical tools with the help of radar screen. We can look at short-term versus long-term changes over different time frames. All right, so now we're going to go to the workspace, and this is radar screen on the left. Now you're going to notice this radar screen has 3 tabs. We're going to start off with key ETFs. So when you look at this right off the bat, I have them broken up by sectors and then indexes and industry ETFs. And these are different indicators. And I've shown these to different people over different time frames, but some of these are maybe ones you haven't seen before. So right off the bat, it's interesting. Energy is the only sector this year that's green. Pretty interesting. But then when you look under that, you see utilities, which are kind of like, I don't know who even really pays much attention to utilities, but then you also have healthcare. Very interesting. So there's a few things I wanted to kind of show you here about. This isn't rendering as I would like. Let me get this to kind of, wait a sec. All right. This is not, all right, I wanted this to be able to show more clearly, but for some reason, you know what? I'm going to close this workspace and reopen it. For some reason, one second. Didn't work quite. I added something to this, and then it ended up changing the scaling on me. So what we're doing here is we have essentially the radar screen with 2 charts. The daily chart is here, and a weekly chart is here. And we have a few different indicators. All right, here's what we want. The white line, there's a lot of things in these charts. So let's start up, like I mentioned, look on a year-to-date basis. We can see, that healthcare is outperforming. So this radar screen is set up in a way that if it's the S&P 500, or in this case, SPY, it will highlight with this amber color. And by doing that, we can always see, okay, on a year-to-date basis, these are outperforming SPY and these are lagging. But if we want to switch to like a 1 month, which is 21 days, then we can see, boom, we can quickly see who's doing better over different time frames. Now I'll mention that I use SPY instead of the cash index because the cash index sometimes has a different time frame. If you use all ETFs and you don't mix in futures or cash indexes, you're never going to have a problem with your charts having different time intervals. Now these charts are pretty complex, especially this one. So what this one does is this looks at different symbols, one against the other. And if you were to put in a symbol like the cash S&P 500 or futures, it would not want to work with the ETF. If you use all ETFs, you're going to have the same price delay on all of them. So that's the reason why we use SPY for this. So what we see with this is we can see, all right, year to date, we see that SPY is outperforming. That's nice. But now look at healthcare. Okay. This on the weekly shows two different things. It shows healthcare as a ratio against SPY. So let's actually look here at data and go to edit symbols. And you can see that this chart actually has two symbols on it. It has down here, what it has is as an indicator called spread ratio. And if we look at this indicator, we double click on that white line, you can see the inputs are data 1 and data 2. Data 1 is the XLV and data 2 is the is SPY, and it's going to do one as a ratio against another. So when healthcare is gaining as a percentage of the market and there's money flowing to healthcare, you see it rising. The other thing on this chart is simple relative strength, and that's going to be shown by these blue and red. And in many ways, that is not always going to be as visible. So having both can really help you. Now let's take a look at XLK. If you look back when the whole tech boom was happening, you could see here that XLK was consistently gaining percentage inside of the SPY. And now look how it's been basically topping out. You could even call that a head and shoulders, this to this to this. And look how it's been red on the relative strength really for the last year. So what's interesting is when this happens, it tends to last for years. And so from my perspective, this is something here that this argues exactly of what I'm mentioning, of the potential for there being a prolonged period of change of leadership. And when we want to look for those areas where the strength is going, the weekly chart with the ratio of the industry versus the S&P can show those trends pretty clearly. And like the combination of relative strengths, here you see a lot of blue and very small little red bars. And you see a lot of red more recently. And then if you look at healthcare, you see just the opposite. You see a lot of red, in 2018, 19. Even with healthcare going up, it was lagging. And then you see really in the last 9 to 10 months, you see just the opposite. And look at how it's been gaining. This to me is very interesting. The other thing that's interesting about it is everybody knows healthcare is growing as a percentage of GDP because of our aging population. So when you think about it, it would make sense to see it gaining as a percentage of the S&P 500. So these are some of the tools that are popping up. Now, just if you don't know this, if I click on something here, it pops up in these because I have symbol linking enabled. Just so you know that you can change these colors. And in this case, they're all set to green. All right. So the first thing is comparing different time frames. The other thing I want to show you is comparing an ETF to a moving average. And this indicator is a custom one I created just for you guys in this webinar. And if we go to studies and edit, what it's going to show you is it's going to show you 50. So what this means that the XLV, for example, is 7% above its 50-day moving average. Something like XLE energy is 2% below its moving average. So looking for ETFs that are above the moving averages, like something like the 50-day, you can change that to 200 or another moving average if you want. You go in here, you can edit it and just change it yourself. This can also show you when you look for the ones that are above the 50-day moving average. It's a very simple form of technical analysis, but it can actually show you where the relative strength is. I think in this case, it's not necessarily just like outright buy signals, but looking for things that are above that moving average will give you a sense of that intermediate or long-term trend. The other indicator, I'm going to do the next slide. The other one I want to show you on this is distance from 52-week high, or I call it here, proximity from 52-week high. This is an indicator that basically shows the distance from the 52-week high. It actually shows today's high price against the 52-week high for the stock. And what this shows you is this can show you areas that are pushing pushing their highs. I mean, look at technology here. Technology is nowhere near its 52-week high. But when it was in the uptrend, this number, it looked just the opposite. XLK was up here, and something like healthcare was down here. That's what it looked like 2 years ago. Now it's flipping the other way. So this is an indicator I also created that I've given you guys a lot, but it can also help you see those areas that are pushing the 52-week highs. And it's a pretty useful, it's very simple, but it can be pretty useful. This other indicator I have here shows you, how many, like, is the 8-day moving average above 8-day exponential against the 21-day, and it counts how many days since the cross happened. And it can also kind of show you shorter term momentum. And in this case, the XLE, the energy, just had the 8-day EMA fall under the 21 EMA. And some people use that as a bearish sort of indicator. Not to say that necessarily it's bearish overall, but the thing is that it kind of tells you that, in the last 2 to 3 weeks, the energy, the mojo has kind of left that space. But if you look at something like, XLC, I mean, short term, it's kind of had that cross above. I mean, long term, it's a whole different scenario. But all these things used together can give you some interesting sense of where the individual sectors are. All right, the next one I want to go on to, let's go to slide 13. Okay. Actually, before I do, I want to just mention, these are the main sectors. There's 11 main sectors in the S&P 500. And then we have these other kind of nuanced ETFs. These are not necessarily things that are even worth investing in. None of these things are recommendations or even a suggestion that these instruments are actually worth doing anything with. These are to find the areas of strength in the market on a sector level. We're using them for analytical purposes only. But here we have airlines, metals, biotechs, pharmaceuticals, retailers. You can look at some of these. It tells you what they are. And you can also look in this and you can start to see where are those areas of strength down here. You'll notice I have these labels so that to kind of separate the groups so they don't all run together. It's pretty useful the way to use radar screen. So this allows you to take a deeper dive inside of the market. And this up here are the broader sectors. So for example, SMH, the semiconductors, is part of XLK. It's pretty interesting to see the semiconductors are above, they're so close to the 200-day moving average. And then the XLK is below. It's interesting that we've seen more relative strength recently in semiconductors. That kind of grabbed my attention. I've been watching that recently. And then if you look at something like the software companies, they've been much weaker more recently. I mean, the semiconductors are to me very interesting because they're surprising me of the relative strength they're showing. You can see this big blue bar here, and it's just kind of interesting. There was a lot of concerns about China, and some of the things we're seeing in semiconductors is also an interesting signal for the economy, because if we're heading toward a recession next year, the question is, would semiconductors be where they are right now? Okay, so another indicator is RSI Pass Custom Study. Now, this is a special one that I created, and I have found this to be actually a very useful and interesting indicator. It uses the RSI indicator. All right, sorry, we're on slide 13. Okay. So what this thing does is, people use RSI for stuff being overbought or oversold. But one of the things I've noticed when things are trending is that stocks that are bullish or sectors that are bullish tend to hit the RSI overbought a lot, and likewise to the downside. So look at energy, for example. Energy went overbought back here in October of last year, and it basically continued to new multi-year highs. Now, if you look at the NASDAQ, it did just the opposite. Once it hit oversold, it pretty much has just been dead in the water since. So what this thing does is, when something goes to overbought, it starts counting, and it basically will stay positive. And if it goes to oversold, it'll start counting down from zero, -1, -2, -3. So the more negative it is, it basically means that it's been in an that it has stayed in an oversold condition without hitting an overbought condition. So it's just an interesting little indicator that I have found useful because, when you look at something like I just said with energy, once it punches up to hit that overbought, sticking with it is often a sign of relative strength, and likewise to the downside. So this is another tool that I wanted to share with you guys. Let's actually see what healthcare is doing there, because I haven't looked at it for a while. Interesting, it just hit an overbought, which is pretty interesting. And it's an interesting sort of sign of relative strength, especially as we go toward a new year. All right, I showed you the spread ratio. Let's go on to slide 14. All right, so that was using ETFs. You want, the approach is to look at things that are performing well over different time frames, find the areas that are outperforming in a certain amount of time, and then using these other time frames, using things like distance from moving average, is it above or below the moving average, and then to use that to assess strength, and then to look at the weekly to see is the ratio doing well or not. It's interesting also look at something like industrials, same sort of thing, this kind of gradual basing after a long period of underperformance. Industrials also, when you think about the cyclical economy, interesting to see that. And look what I said about the industrials, like the construction engineering firms. So this is a leading part of the industrial, economy. It's interesting to see that relative strength, and to see this also, this gradual increase in the ratio. All right, so that was with ETFs. Now we're going to go to the next tab, stock testing. This is the S&P 500. I'm going to just quickly do this. I'm going to erase the whole thing, Control-A. If you want to ever do this, go to Data, Add Symbol List, S&P 500. It's going to bring in the whole index for you. You can add the NASDAQ, you can add the Dow, you can add your own list of stocks. Wanted to just show you, if you're ever curious, that's how you can do it. So this allows us now to dig through the entire S&P 500. So some of the things here that I just want to just very quickly do is to show like the stocks that are also like doing certain sort of technical things that might be of interest. So we can see here, for example, stocks that have pulled back to hit the 21-day moving average. Now, what this will do is this will tell you if that moving average is rising or falling. This can be a very simple way to find bullish flags. If the 21-day moving average is rising, it means the stock's movement in the last 2 to 3 months is higher. If it pulls back to touch it, it means it pulled back. So right off the bat, looking for some of these signals can give you potential signals. So some of the things I like to do, say, for example, I want to see stocks that are outperforming in the last 3 months. And I'll sort by this, and now I see all the stocks in the S&P ranked in this time period. And then I can say, all right, if it's up 10% in the last month, I'm happy. I'm going to go down here and I'm going to go to Data, Add Label Row, and I'm going to just add a block. And then what I can do is, but these are up a lot. I want to pull back. So now you can go back and click on 5-day, and boom, you're immediately going to start to find stocks that are pulling back. Now, these are energy stocks off the top, but now you already knew from the first ETF that maybe energy here has some signals that are not terrific. But there are other areas, for example, that I'm just kind of look down the list and start to see what pops up. For example, something like Etsy is kind of interesting. This one has been gaining relative strength. It's very interesting to see Etsy, the way it's performing versus something like Amazon. Look at Etsy and now look at Amazon. So a name like Biogen, very interesting name that I'm just looking at this. I haven't run this scan in a few days. So basically, here's a company that has some interesting sort of, Alzheimer's drugs being developed. Interesting. It's in the healthcare sector. So that's just kind of interesting. Now, of course, we set this up using the sector indicator. So you see right off the bat, you already know from here where your areas of strength or weakness are. And then right here, when you look at individual names, you're immediately seeing and you're knowing, what it is. So that's a way to use finding potential opportunities, using the 5-day, using this combination of 5D with 63D, which is basically 1 week change versus 3 months change. And you're just using 2 different time frames. You're first creating your list based on longer term, then you're segregating it with your label row, and then you're coming back and resorting it with your short term. Very simple method, and I use it all the time. And I mean, mathematically, it's always going to find these opportunities, because they have to be up in the last 3 months, and then they have to be down in the last week. Otherwise, it wouldn't pop up. So that's one method right there. Okay. Another thing is to look for the recent moving average crosses. If you actually jump ahead to slide 15, I kind of show you, this is slide 14 and 15 together, just so you realize I'm basically doing the steps where I'm doing the label row. So first, let's say, for example, we want to find stocks that made a new 52-week high in the last, say, 2 weeks. We use the indicator. There's another custom indicator, Dason's 52-week high. We then sort on the high, and we say, all right, I want to find stocks with a value of 10 or less. So I go here, I insert, I go to data, add label row, just sort it out, and then I can click on 5D and quickly see these are names that recently hit 52-week highs that are now pulling back. Again, we have some energy there, but there we have Biogen pops up. MetLife. I mean, what on earth is, when's the last time anyone even thought about names like this? But there it is. It's breaking out to, is it possible MetLife is actually breaking out to all-time highs? What on earth? I had no idea. But see, that's what TradeStation and Radar Screen can show you. SNA. These are a lot of these are maybe names that are not that interesting. They're not very liquid. But here we go. ADP, the payroll company. Again, same sort of pattern. You see it on the daily chart here. You see the relative strength. Look at ADP versus the S&P 500 in the last 12 months. It's pretty interesting. All right. So the other one I want to show you is the recent. All right. Let's just click on it, hit delete. Bye-bye. All right. Now we want to find things that recently had a cross of like the moving average crossing in our favor. So we do here is we can say, I want to find stocks that had a recent 8 and 21 cross. You go to data, add label row, and then you can maybe go down to stocks that had the cross. Let's just say in the last 15 days, data, add label row. And now we go to 5D sort. And we're also going to be finding stocks here that, like, for example, this one recently had, Google recently had that bullish crossover, and now it's down in the last week. Like from my perspective, like I said, we know large cap technology. We know from the first tab that it's not where the relative strength is. So we would kind of look past that using the kind of methodology I would have here. But some of these other names are things to be kind of potentially trying to look at. Chipotle Mexican, that's kind of interesting. High valuation stock with a big sort of technology bent to it, which might not put it in the best place, but you can start to use some of these things. I also want to tell you with this indicator, if you go to MAX day since and you click on studies and you edit it, it by default does the 8 and 21 day exponential, but you can change this to simple and simple or whatever you want. You can say 50-day simple versus 200-day simple. You just want to change it like, you want to use the quotes and then simple like that. Make sure you don't misspell it because it won't work then. But you just change it. I'm not going to change it right now, but you can change these moving averages to whatever you want. If you go for long-term exponential moving averages, you might need to go into general and change the additional bars to load. Exponential moving averages require you to manually change the additional bars, just so you realize that. I'm going to cancel out. But just so you realize, this is totally adjustable. This is one of my favorite indicators. And I love giving this to people because this is one that, I don't know how you create this without TradeStation, that easy language. And that's a whole other course. Remember, this is a lot of stuff that's now going to be covered more and more in our master class, which is another thing that we do offer that we're going to have more information on going forward. Can this recording and any ELDs be emailed? Well, we cannot easily email it, but what I can say is we can reshare the, I'm going to reshare the zip file right here. Look at that first thing I just pasted into chat, and that is the zip file. The recording will be on YouTube in a week or two on TradeStation's YouTube channel, so you can get both of them. Okay. I showed you this process. So some of the things we used here were MAX days since, custom indicator just for you guys. Days since 52-week high low, custom indicator just for you guys. All right, another thing is just to quickly show you, I just want to mention, the EMA test. This is one also where it's another custom indicator that I'm just giving you guys. And, like I said, the nice thing about this is you can see right off the bat, the sector it's in, and you can start to have a sense of, is the sector good or bad? You already knew that from the first tab. All right. So that is the second method. Let me just make sure I covered everything. The last, like I said, sector, you can actually look here and you can sort by sector. You can say, you know what? Material stocks are doing well. Let's just see what's happening with those. You go to data, add label row, and now let's see this, which material stocks are maybe doing best on a year-to-date basis. And we have something like CF, fertilizer stock. I'll be honest, the metals have been very interesting recently. And there have been a lot of bullish arguments for copper. Freeport-McMoRan is a name that I've been just kind of watching and trying to understand. But there's a lot of arguments in favor of copper, whether it's China reopening or the spread of electric cars. I mean, just anything involving ESG at this point in time, when it's going to have more electricity, all those things are going to, the copper is built into all of that in different ways. Freeport is like, there's only really one copper miner now in the S&P. So it's another thing to kind of bear in mind. And if you look at it over the long term, I mean, it's really gone nowhere for like 12 years. So this is another name that, could be on some people's radar. But, if you want to look by sector, you can also, segregate them, group them by sector, then segregate them with a label row. All right. Now let's use scanner. Even in bear markets, certain stocks may be trending higher. Simply targeting those stocks can help traders outperform. All right, so now what I'm going to do is I'm going to hide radar screen. I'm going to open scanner. I'm just going to go to scanner. Now I want this scanner to work over here. So I'm going to add green local symbols. And now when I click on stocks here, they pop up over there. Now these are other scans I have. So I'm going to very quickly build this scan with you guys. Go to slide 16 to follow. And here we go. I'm going to go to create scan. Let's just call it like a new scan, December 8th. And then the first thing, we're going to select all stocks. And I have these set as defaults. I'm going to remove these. We're going to go to the first thing. We're going to go to volume. We're going to go to volume. And we're going to volume average 10-day. Volume average 10-day. We're going to set it to greater than, say, 500,000. We're going to go to market capitalization. Now notice that I have little arrows in the actual PowerPoint that explain the paths you follow to navigate through these folders, because there's these little pop-up folders. You want to follow those based on. I'm going to set this to 5,000, which is really 5 billion because we're looking at millions. We're going to basically say now price. We're going to go next. We're going to go to the price folder, and we're going to say price as a percentage of 52-week high low greater than 90. And then we're going to say price. We're going to go to the low. So you can look at your low days ago. This is kind of cool. I don't do that much, but you can sometimes say, I want to find a stock that made a certain low 2 days ago, something like that. So the low, and now check this out. This is when it really gets cool. Low, less than, and then we go to indicator. Then we go to moving average, exponential. And now we're going to click on this, open it up, and change it to 8-day. Click on that plus button. This is going to find stocks that are in the 90% part of their 52-week range, and the low touched under the 8-day exponential moving average, which again means you had some kind of pullback. So let's look at some of the names that popped up. Pacific PCG, some kind of utility stock, same thing. It's near the 52-week highs, and it pulled back under that low. TJX, boring retailer, same sort of thing. So this is one thing you can do right off the bat. Can you exclude stocks from a specific country? That is a good question. I've never really messed around with the countries because, quite honestly, the stuff I have for countries is everything is listed in the US. I don't have international, and even a foreign stock will be listed as a US because that's where it trades. So the answer is I don't know. Let's see. Last run, I'm going to add this so I can then sort most recent. Sorry about that. Sometimes it does that. All right. So that was the basic thing I showed you. So here's some other things you can do. You can also do something like say, I want to find stocks that closed above the 50-day moving average, for example. If you want to do that, that's similar to the moving average thing that I showed you on radar screen. You do it differently in scanner. You would just set price. You could do this and you could customize it, and you could change this to move av one line and then change it to 50 like this. This is the one called MOV AVG one line. This is simple moving average. You can now change that, jump in here, change it to 50. And now you're only going to find stocks that are above the 50-day moving average. If it's that close to its 52-week high, it's almost certainly above its 50-day. So that's, in this case, not the most useful indicator, but we could just hide that and then run it like this. Some other things we can do is we can find stocks that made a 52-week high in the last 10 sessions. This would use the custom indicator that I share with you guys, but that would be another way to do it. And then also, you can look at stocks that, what this does is, I want to show you, these other things are little hacks I came up with, these little ways to get more out of scanner. You can say, I want to find stocks where the 5-day change is greater than minus 99. Why? Because by doing that, it will allow me to sort the 1-week percentage change of all of my results. So I can just look for stuff that's maybe down 5% in the last 5 days or something like that. You can say, I want to find stocks that are above the 50-day moving average, but then I want to look at the ones that are down in the last 5 days. And by adding this criteria, I'm going to just show you this really quick. Look at this. I'm running out of time, but here we go. Let's go to price, percentage change, 5-day, less than. I'm going to do something else. Minus 99. That's going to return everything, but it's going to let me sort. The other thing I can do now is look at this. I can go to indicator and I can say industry, or let's just say sector. Let's add by sector. And then we do this greater than, less than, which is does not equal, quote, quote. Now look at this. What this is going to do, and this is one of the hacks I shared here. This will basically force scanner. Wait a second. Make it run. This is what I do wrong. No, we want to change that. I'm sorry, I want to change price. Here we go. We go to last greater than 50-day. I apologize. I did that quickly. Whenever it doesn't work, go back and check all these little boxes because very often that's your problem star. So let's see what this is going to give us. It's going to give us 500,000 a day, 5 billion of market cap, This one has been excluded. I'm going to add this. So the last price has to be above the 50-day. And then we're going to show the stocks that are, wait, I'm sorry, it should be greater than minus 99. See, it's another little thing. All right, now let's run this. What this is going to do is it's going to give us some of the functionality of Radar Screen. Radar Screen allows us to sort by all these things. It allows us to have all kinds of indicators in there. With Scanner, you have to include the indicator in the actual scan if you want to sort on the output. But what you can do is you can put in dummy values like greater than minus 99, which is going to return everything. But then by forcing the criteria in, you then have it as a sortable field. It's a useful hack. And this is still not, why is this not working? All right. I'm not sure what I've done wrong with this. And when you mess around it, if you dig down, you actually look, you're going to often see little mistakes you made somewhere. 50-day, the last is greater than 50-day. Let's just remove that indicator and try again. I apologize for this. All right, here we got some results. If I dig in, I probably did it too quickly. The one thing with Scanner, like I said, you have to be very careful to always check. Now, simply by sorting this, you can now see stocks and you can see them down in the last week. So if you found stocks that were, say, above the 50-day moving average and they were down, you're going to start to see pullbacks by using this indicator, by simply sorting. And this allows you to very quickly bring in a whole universe of stocks and then to sort. And it also allows you to see the sector, which is important because if you know, for example, I don't want to see energy right now, I'm not interested in that, you see it right off the bat. And of course, you can then sort by that. The other nice thing you can do is you can just copy, click on that, on the symbol column, copy, go to Radar Screen, go to stock testing, and then you can select all, delete, and paste in your results. And then you can go through and you can hack around with them doing this. You can start finding these things popping up. The last thing I'll just mention is this is where we find stuff like the property and casualty insurers. I mean, they're not very exciting, but if you look, Aflac, Gallagher, which is like a property, some kind of insurance. There's some kind of wholesaler or something. Marsh McClellan popping up on this list. So this is just to kind of show you that when you look at, this allows you to very quickly see where those areas of strength and where those areas of weakness are. And, it can kind of give you a sense of comfort to know, what, there's institutional money flowing into or flowing away from these. Maybe it's something to actually start looking into. These are some of the methods that seem to be finding, the areas of strength. I noticed, for example, earlier in the year, I wrote about McKesson and Cardinal Health. And these stocks were just so boring, but here they were, the market was getting hammered and they were just like sitting near their highs. I found them using these sort of tools and they've just continued higher. The same thing like with Merck and a lot of these other, I've been talking about these big pharma names for several months now because they kept popping up. All I do is I look at Radar Screen and I let it give me the information. So hopefully you guys, are able to use some of these tools and you get a lot out of this. From my perspective, I just want to emphasize that historically, you see a change of market behavior coming out of bear markets. We saw it coming out of 2000. We went from tech to housing to consumer. Then coming out of the, another period of time, you started to see the emerging markets and commodities outperform. Then around 2012, they hit the wall. You started to see healthcare outperform. Then a few years later, you saw tech outperform. And all those phases have passed. They last 3 to 6 years. Now, here we are at the end of another one. And now is the time to consider widening our horizons, looking beyond the big NASDAQ names, and using some of these methods, you can start to find some of the areas where money could be flowing on a more substantial 2 to 3 year horizon. That's what we're looking to do. Hope you find this interesting. Hope everyone has a great day, Merry Christmas and everything else. And I'll see you soon. I'll see you in January. We'll be doing another one of these. Take care.